Hey guys, and welcome to my latest episode of my investment portfolio. So from the last episode, we've had quite a big change in the portfolio, and as you can see, a lot of value has gone from our portfolio. Now, the big change is that we're no longer in the red, and that is because of a couple of reasons. So in the account, we actually have just under £1,600 available to spend, and that has nothing to do with me putting any more money in. This is the exact same value as the account from the previous episode. And if I was to scroll down through all my shares, you will notice that Blackberry, I don't have any more money in it anymore. I just have 0.7 left of a share, and that was because I managed to cash out Blackberry when it peaked. So it's had a bit of a run again, Blackberry, and it peaked roughly at about £19. And due to the last time I was purchasing Blackberry when it last had a bit of a bull run, I put a sell offer in at £19.27. Now, I never expected that to sell. That was more of a case of if Blackberry ever did do the run it just had, I was in the market and I was available to sell at a price I was comfortable with. And due to this, I pretty much sold Blackberry at the peak, and ever since it's gone down. So because of that, we've managed to cash out on Blackberry for, I think it was roughly about a £7 per share profit, which means we've made the best part of £700 just from cashing out on Blackberry. Now, after Blackberry's been sat at the £8 mark and we were sort of 50% down on the stock, we've actually cashed out for quite a good profit. So that is why throughout all these episodes, I've been saying I will just hold for the opportunity to sell, and then we can put it into the more sensible stocks, which I should have done from the beginning. But we've got a bit, I'm not going to lie, we've got a bit lucky here, and we've managed to shift it, and we've actually managed to shift it for a profit as well. So Blackberry is the main reason I've got so much cash available, but another reason is we have actually sold out of AT&T. Now, I've decided to do this because of the main reason that AT&T have cut down their dividend. So their dividend used to be 7%, and now they've dropped it down to 4% dividend. Now, they've done this to obviously preserve cash for the company and to make sure that the company has enough funds to keep going. However, they are starting to sell parts of the company off, which I think were the more futuristic and possibly the better parts of the company. So I don't agree with that decision, and that was really one of the main points, along with the dividend cut, as to why I've cashed out. Because with AT&T, in my opinion, the main reason you would keep hold of them was because of the dividend. So that's pretty much why we've got so much cash available. In terms of the rest of the portfolio, we are actually in the green. So we're 5% up of sort of how much we've invested in. And that's just generally because the market's on a bit of a positive run at the minute. All the companies which at the minute are in the red in my portfolio are companies which the majority, like Neo, Sensasonics, Sophie, and Ehang, have all were sort of like meme stocks, and there was stuff I really shouldn't have got invested in, and I don't know why I got invested in. I got the fear of missing out, and I decided to purchase them. And ever since then, they've done nothing but lose value. So I'm trying to reduce my sort of footprint in them companies and spread the money more even across all of the other companies in my portfolio, which have a lot more sort of value and more blue chip stocks, more reliable, and got a history of providing a form of dividend income as well as growing their stock price. So that's what we're going to do in this episode. We've got £1,600 to split between these companies. The portfolio now has got a lot more balance to it than before. I think it's time just to keep growing what we've already got and just talk through what we're doing. So as you can see now, my portfolio, rather than have the main percentage in just Blackberry and AT&T, it's got a lot more of diversity now. It's got splits a lot more between the holdings. So we're just going to increase that for this episode. So just going to go through some stock picks, what we're going to invest, and we'll go from there. So we are going to pick up some 3M. Now 3M, construction side, and coming from the construction industry, it is a company which will always be valued. They'll always have some form of input in the market because construction, especially with the housing prices at the minute, will just keep going forward. And it's one of those where it needs to be part of the economy. So there's always that scope of being able to be around. Apple has had a bit of a wobble lately. but it's still Apple, it is still the powerhouse, and it will still have value in years to come. So we're going to pick up 2 shares of that. Companies at the minute which are doing very, very well are the banking companies. Now, there's 2 I've got in the watch list as well, which we'll talk through after this. But I'm going to pick up some Bank of America because that's done very, very well in the past couple of months. Coca-Cola is a very well respected dividend company. It's doing well at the minute. So we'll pick up some Coca-Cola stocks. And that's really what I'm trying to do with this portfolio now. I'm just trying to spread the money between all these companies and just make sure that I've got enough diversity available in the portfolio. So whereas a couple were to go down in price, I don't mind because I'll have other companies which still produce an income. All these companies produce dividends as well. So they will be a constant cash flow in time as well. So we just going through and buying all these companies. I'll come back at the end of the episode and we'll talk through the portfolio then because I'm just going to eye up what I want. We'll buy these new companies which I'm going to bring into the portfolio as well, and I'll just talk through why I'm doing it and the reasons why. So one of these new companies I'm going to pick up is JP Morgan and Chase. Now, the financial companies are the ones which seem to be doing really, really well at the minute. So even though it's on a bit of a downward trend, JP Morgan has really grown quite well over this past year, and it does seem to be one of the forefront banks in America. It seems a lot more sort of solid than companies like Wells Fargo. So we're just going to pick up a little bit of that just to start it in the portfolio as well. 2 other companies I want to pick up in the future are MasterCard and Visa, because although they're very low dividend companies, they are very reliable, and I think we're at a bit of a point in the world where the financial side of the world is going to change a lot. I don't think with the rise of cryptocurrencies and stuff like that, I do think we're at the cusp of moving technologies to how we pay for things. I think the use of contactless will just keep growing because I think physical money will become less and less. So Visa and MasterCard have got a massive scope in the market to really push forward. And I think the banks as well, with how the world's going to go and interest rates probably changing, the banks have really got a chance to capitalise and profit. I think the way we're going in terms of the world's financial problems, it's probably the best place for me to put some money at the minute. And the banks do play quite good on dividends. So that's the plan at the minute. Obviously it will change. Will it go wrong? Maybe, but that's why I try and spread out all my money as best as possible, and I still have a lot more faith in this portfolio than I do having it as savings in the bank. So just to go through a bit of a quick breakdown of what I bought. So we just bought that JP Morgan, and we've just bought some Total, Shell, and all these other companies as well. We've just really bulked out our positions and just put a bit more money across the board for everywhere. So I'll just show you my allocation. As you can see, we've gone a bit heavy on Apple, so Apple is now our lead shares, but we've just split the money across all the other companies we've got, just so we've got a very diverse and evenly split portfolio. And I think just for the time being, that's probably the best way for us to put the money. We've still got some positions still waiting to buy, so we've still got £300. But yeah, compared to how my portfolio was looking about a month ago, this is a lot better and I'm a lot more comfortable with it. The amount of shares I sort of want to get rid of are under 5 now. I want to get rid of Sensasonics, Sophie, which did have a bit of a peak a couple of weeks ago because they have merged with another company, but it didn't quite do enough to where it was breaking even for me, so I've held on to it just in case it can go up in the future. Neo and Ehang are the companies I want to sort of move out of the portfolio and use whatever money we've got left just to invest in these companies here. But it's looking a lot better than where we were. So if you've enjoyed the video, please leave a like, comment and subscribe. I want to start pushing out a bit more content to this channel. And I want to keep these videos a bit more monthly or every sort of 2 weeks. I don't think I'm invested enough at the minute to do a weekly video. So I try and find some other content to put on the channel. But yeah, I want to keep pushing videos out for you guys. So if you've got any suggestions or any topics you want me to talk about, please leave them in the comments and I'll do my best to do so and I will reply. I'll see you guys in the next video.